The Bank of Japan shocking global markets overnight, tweaking its yield curve control policy. And our senior economics reporter, Steve Leisman, has more on this. Hi, Steve.
Hey, good morning, Morgan. Until now, the BOJ has been the odd bank out when it comes to tightening monetary policy amid higher global inflation. Now the question is whether the policy that it's tweaking now whether or not it's joining the tightening crowd. But this morning, the BOJ, Bank of Japan, surprised markets around by lifting its cap on 10-year Japanese yields to 50 basis points from 25. The effect has been global. U.S. stock futures plunged, then rallied most of the way back. Treasury yields surged and the yen strengthened. The dollar weakened and on the move, which was generally not expected for several months. The trouble for understanding this move is that the governor of the Bank of Japan insisted this is about improving market function and maintaining yield curve control, not the beginning of a tightening cycle. Governor Kuroda saying at his press conference, quote, "Today's step is aimed at improving market functions, thereby helping enhance the effect of our monetary easing. It's therefore not an interest rate hike." The BOJ's problem had been that the 10-year yield was continuously trading at the top of the range, or 25 basis points. Other maturities have been volatile as well. Japanese inflation, looking at that, has been on the rise, moving from deflation in April to now show positive rates for both headline and core, though core remains below the 2% target. Kuroda suggested the inflation comes mostly from higher import prices, not from domestic sources. Okay, where are we now? Markets have to figure out if they should take Kuroda at his word that this is about market functioning, not the start of a tightening cycle. And then they have to prepare for Kuroda's exit in April, where a more hawkish governor could be coming in. Morgan?
You just touched on it, market function versus policy tightening. Nonetheless, the move that we're seeing in the bond market in Japan right now, what does that mean? How does that translate to U.S. Treasuries and competition we could see here in this market and activity in this market?
Yeah, I think you hit the right word there, Morgan. It's competition. You have higher rates in Japan, so marginally higher rates. Look, the Japanese, the Bank of Japan owns about half of all outstanding JGBs, is my understanding. So there's not a tremendous impact in the private sector. Japanese fixed income investors tend to stay home. But, yeah, there is this sort of knock-on effect where higher yields we're seeing higher yields in the United States, in part because of what happened this morning or last night in Japan.
Okay, Steve, stick around. Want to bring in senior markets commentator Mike Santoli to this discussion. Mike, want to get your thoughts on this as we see stocks waffle today amid lower volume.
Sure.
With a lot of potential for volatility as well over these next couple of weeks because of the holidays.
Yeah, I see it affecting us in a couple of ways. One, it's a little bit of a test to have an overnight jolt into an illiquid market, a 3% move in the U.S. dollar-yen exchange rate, and let's see if something else gets knocked loose in the markets on that kind of a move. So far, it doesn't seem like that's been the case, so I guess that's just a very modest, test passed. And then I think, as Steve's been alluding to, it's the way it has released other global yields higher. And it's happened at an interesting spot because U.S. Treasury yields, German yields, any of that you want to look at across the world, had a very similar setup where they had pulled back to the highs that were reached in the mid part of this year. And now it seems like maybe that's a short-term floor and maybe we can rebuild toward that. It's not because of this necessarily altering the global central bank tightening story or anything like that. It just seems as if we're now have the anchor of Japanese rates is a little bit set higher. And that's about all it is. Now, when it comes to our stock market, I mean, I don't think that you want to see the dollar go down for this reason, but a weaker dollar has been compatible with our market getting a little bit of relief, especially when it is the, kind of the global earnings story has been, I think, a big worry point into next year.
Yeah, I mean, speaking of our market, Mike, and we're basically flat on the S&P right now. I mean, we came in again with quite a few down days in a row here. The NASDAQ down 33% year to date. Showing some signs of life, but sort of any thoughts, particularly as Morgan mentioned, given the time of year we're in right here?
Yeah, I mean, starting to get in the short term a little bit stretched. I mean, if you think about the high that we hit in the S&P 500 on the celebration of the good CPI report, that was a week ago today, 4,100 to the penny. Yesterday's low, 3,800 to the penny. So it seems like the market wants to try to test, see if this is a range that we're comfortable with. Valuations continue to bleed out of the most expensive, popular mega cap NASDAQ stocks. That's been a constant all year. That's been a bit of a weight. The rest of the market has found a way to kind of stay supported at the lower end of this trading range. I think that's what we're figuring out right now, if that's going to be something you can bank on or not.
Yeah. Speaking of banks, Steve, I just want to shift gears a little bit because to go back to the conversation we were having with our banking analyst just a few moments ago, one of the things he mentioned was the possibility of a credit event. The non-bank lending portion of that market certainly been getting more attention, I think, in recent days, recent weeks, and then just yesterday you had that op-ed from Bill Gross flagging things like private equity and some of these areas where there could potentially be another shoe to drop. I guess just walk me through what that means in the midst of this Fed tightening cycle and whether central bankers are watching some of these, dare I say, more shadow credit areas of the market pretty closely in light of that.
I think they're watching them, and certainly somebody's going to go broke in this process. Somebody was out there long, forever low rates and is going to get caught short. Some folks are going to have to refinance into higher yields than perhaps the business that they financed before can withstand. The key to look for, Morgan, from my standpoint, is to look for tentacles of this lending back into the banking system. So far, so good. It looks like crypto did not come and create big losses inside the regulated banking system. I've been looking at corporate bonds, which have a big refinance shelf. It looks like 24 and 25, but not next year. I've been looking at commercial lending. They have, probably the office space is the one that's going to be hit the hardest. I see a big shelf again down the road, not so much next year, but there is going to be office space. There's going to be corporate bonds. There's going to be all sorts of stuff here, David, as you know, and in the private equity world, that's going to be displaced and perhaps in a dramatic way as a result of these higher yields.